Yeah, look, I think there's three things, Kevin, I'd like to really leave the room before we go. First one is I think the opportunities are there in scale. The demand and the depth in the buyer pool is really coming from the bottom up, and although there is increasing depth at the top end of the market, say for suburban, that's probably 20 million plus, it still is thinner at that level than it is at the bottom end. So to be able to club enough equity together and get into that market is where I see the value. In terms of commercial developments, we've already touched on that. I still think that's something to look at, particularly on the fringe, and preferably with something with income flowing in the meantime, because that could be 2 to 3 years away at least. And finally, I think people need to recognise how quickly the cycle has turned. It was only 12 months ago that we were looking around, scratching around for buyers, and now we're scratching around and tapping our vendors on the shoulder. And for that reason, I think it's a good trading market and a good opportunity for people either to be adding or rebalancing their portfolio in what are good trading conditions.
I think there's some terrific ideas there, so please join me in thanking Andrew and Grant. Okay, we're going to move on now to the industrial sector now. Of course, Melbourne is a famous industrial market. It has a long history in first manufacturing, which is now, of course, declining in importance, unfortunately. But it's being replaced, at least, by a very strong logistics sector. It's important sometimes to reflect just how far Melbourne has come as an industrial market. And when we look at the total stock of industrial floor space, in Australia, we know from our counts that we focus on very closely, there's 111 million square metres of industrial floor space now in the capital cities of Australia. Melbourne represents 34% of that, or about 38 million square metres now in Melbourne. This is an enormous market, and it is the biggest market in Australia. The construction activity here, which is a real sort of feature of the market in terms of pre-leasing and owner occupation, has been running extraordinarily hot in that period about 2003 to 2008. On average, 1.2 million square metres of new industrial floor space was being built per annum. Now, a large proportion of that, maybe 70–75%, has been in the form of warehousing and logistics centres. As I mentioned, the manufacturers going offshore are being replaced effectively by logistics operations, and now, of course, the dredging project is finished in the bay, and it provides more scope when the economy is ready to increase the volume of containers coming through, and will probably give another spurt to industrial construction over the next 12 to 18 months, maybe 2 years. The industrial sector can shut down very quickly because it's so heavily reliant on pre-leasing, especially on big projects. And that's what's happened in the last 18 months. The pre-leasing demand shut down, the financing for new development closed off, and we saw construction levels virtually half in 12 months, just 12 months. But construction activity is picking up again early in 2010. We've got about 200,000 square metres under construction, but there is an enormous pipeline that's been left. And when we think about 600,000 square metres has either been development approved or applied for, and another about 200,000 is also on hold. So we think it's now starting to happen. Leasing inquiry is starting to pick up. Again, very much from the logistics side of the sector as the principal driver. And the market is ready to expand again. The screws will come off very quickly as that pre-leasing demand picks up and finance starts to flow gradually. And we don't think it'll be very long before the construction activity in Melbourne is back up over the million square metre mark. I guess, when you look at container traffic, and it really is one of the key drivers now, this chart shows you the comparison of TEU movement in Melbourne, Sydney and Brisbane. And you can see that Melbourne has actually dropped for the first time in 15 years in the last 12 months. So it's showing a very strong relationship to industrial construction. It's clearly now the key driver of the industrial market. Transaction volume in the industrial sector has fallen quite rapidly, probably more dramatically than any other property class. In some ways, the change that's happening in industrial is probably more has impacted more, I should say, by the downturn in the last 18 months than any other sector. Trading activity dropped dramatically, around to $200–300 million in the last 2 years. The purchases, of course, during this quiet time have been predominantly the private interests, either private investors directly or in the form of syndicates, or perhaps even as owner-occupiers. You can see on this chart the purchasers in the dark green and the vendors in the light green there. Clearly the A-REITs were getting out and private investors were getting in. We sort of contemplate how this will look in 12 months' time, perhaps reversed around as the A-REITs come back into the market in 2010 and the private investors are reduced in proportion. I guess the yield curve now is stabilised and expected to start to compress also in the year ahead. The peak yield is now about 8.6, 8.7%. We've seen a blowout of about 300 basis points in this sector, more than any other property class. And we do forecast a compression of around 30 basis points this year and a bit more in the following year and a bit more in the following year. So it's a more gradual process of return of value in this industrial sector. This chart shows you the capital value rise and fall. It's quite dramatic. About 30% have been washed off capital values in industrial, more than any other sector, as I've mentioned. But it's also now stabilised, and this is the theme we're seeing, that in the second half of 2009, so many of the indicators were stabilising. And in the cycle, where confidence is returning, we do expect to see a rise in these values over 2010. You can see where we think the growth will come from in the industrial sector, where it has come from, and where it will come from in the next 3 years. The dark green being the basis point change in, the percentage growth in rentals, and the light green being the basis point change in yield. So both will gradually improve over the course of the next 3 years. The other key thing to mention about industrials, that one of the legacies has been a drop in land prices. Now we've seen this right around Australia. The fall in Melbourne has been about 20% on average. It's been much more in other parts of Australia. So again, Melbourne gets off relatively lightly on this front. Of course, land prices hadn't risen so much here anyway. But we want to sort of reinstate the point that these land value falls are now also stabilised. So are now also, we think, poised to rise. So let me summarise the industrial sector as we see it for the next 12 months. Occupier demand is certainly picking up, and we're starting to even see deals done very much back to where they were in the warehousing and distribution part of the market. We know there's 1.2 million square metres of new stock in the pipeline. Investment activity, we think, is set to rise like the other sectors as confidence returns. Yield compression through 2010 with more to come in the following years, and land values now have stabilised. So I hope that gives you a quick snapshot of the outlook for the industrial sector, but to really give the insights from out there in the marketplace, this morning I'm thrilled to invite to the stage Walter Occhiuto. So please join me in welcoming Walter to the stage. Welcome, Walter. Okay, I thought we'd start this morning at the top of the topics. Prime investments. What's happening with the investment market in industrial? Is the phone ringing now? The investors really starting to, hassle you and say, "Come on, where's the stock?" What's happening?
Absolutely. There's certainly a groundswell of inquiry, and that really started at the beginning of last year, and that was fueled predominantly from the private client sector of the market, who have traditionally been pushed out of the market or squeezed out of the market, not really been given many opportunities to acquire premium assets. So with the absence of institutions throughout 2009, privates came back in a big way, and we're really looking to obtain full value out of, from a yield point of view, and also the opportunity to buy premium assets which had previously not been offered. A great example of that was the toll deal out in Altona, new building, 12-year lease, circa 20 million. That deal was done at about 8% on a pretty full rent, and really gave investors the confidence to be able to move forward and really start being a bit more aggressive in acquiring A-grade stock.